Causes of changes in supply. Among the factors that can cause a change in supply are changes in the costs of production. If it costs more to produce a product, suppliers will want a higher price for it. The two basic reasons for a change in costs of production are a change in the price of any of the factors of production, a change in their productivity. If, for example, the price of raw materials used increases, it will be more expensive to produce a product. One cost which changes frequently is the cost of transporting goods. This is because the price of oil used in petrol is itself very volatile. Definitions. Unit cost, the average cost of production. It is found by dividing the output by the total cost. Unit cost equals to output divided by total cost. A rise in the productivity of a factor of production will reduce unit cost. If, for example, if a worker who is paid 200 rupees a week produces 100 units, the labor cost per unit is 200 rupees divided by 100 units, that is 2 rupees. If his productivity rises to 200, the labor cost per unit would fall to 1 rupee. An increase in the wages paid to workers by itself would raise the costs of production and therefore cause a decrease in supply. It is interesting to note, however, that if it is accompanied by an equal rise in productivity, then unit costs and supply will remain unchanged. Activity. A firm employs 10 workers and pays 50 a day to each of them. The total output of 10 workers is 100 units initially. The firm then raises the wage rate to 60 a day and the output per worker rises to 120 units. A. Showing your workings. Calculate. 1. The initial unit cost. 2. The new unit cost. B. Will supply decrease, stay the same or increase? Explain your answer. A. Part 1. Unit cost is total cost divided by output. In this case, 500 rupees divided by 100. That is 5 rupees. Part 2. The new unit cost is 600 rupees divided by 200. Coming out to be 3 rupees. Part B. Supply will increase as costs of production have fallen. Improvements in technology. Definitions. Improvements in technology, advances in the quality of capital goods and methods of production. This influence is closely related to the previous one, since improvements in technology raise the productivity of capital, reduce costs of production and result in an increase in supply. It has become much cheaper to produce a range of products due to the availability of more efficient capital goods and methods of production. Whilst world demand for personal computers has increased in recent years, the supply has increased even more as it has become easier and cheaper to produce them. Tax. Definitions. Tax is a payment to the government. Indirect taxes are taxes on goods and services. Taxes on firms, including corporation tax, and indirect taxes such as value-added tax and excise duty are effectively a cost that firms have to pay. They are likely to try to recover at least some of this extra cost by raising the price paid by consumers. Nevertheless, the firms themselves are largely responsible for passing on the tax revenue to the government. A rise in the rate of an existing tax or the imposition of a new tax will make it more expensive to supply a product and hence will reduce supply. In contrast, a cut in a tax or its removal will increase supply. Subsidies. Definitions. Subsidy: a payment by a government to encourage the production or consumption of a product. A subsidy given to the producers provides a financial incentive for them to supply more besides being paid by the consumer. They are now being paid by the government also. As a result, the granting of a subsidy will cause an increase in supply while the removal of a subsidy will cause a decrease in supply. Most countries, throughout the world, subsidize some agricultural products. A number of them also give subsidies to new and important industries. Less frequently, a government may also give a subsidy to consumers, to encourage them to buy a particular product. For example, grants may be given to people to enable them to buy houses. In this case, of course, it is demand and not supply conditions which change. Weather conditions. Changes in weather conditions affect particular agricultural products. A period of good weather around harvest time is likely to increase the supply of a number of crops. Very dry, very wet or very windy weather, however, is likely to damage a range of crops and thereby reduce their supply. The amount of agricultural products produced and available for supply is also influenced by the health of livestock and crops. The outbreak of a disease, such as foot and mouth in cattle, or blight in crops, will reduce supply. Prices of other products. Firms often produce a range of products. If one product becomes more popular, its price will rise and supply will extend. In order to produce more of this product, the firm may divert the resources from the production of other products. The prices of these other products have not changed, but the firm will now supply less at each and every price. For example, if a farmer keeps cattle and sheep, a rise in the price and profitability of lamb is likely to result in the farmer keeping fewer cows and a corresponding decrease in the supply of beef, besides the products being supplied in a competitive environment. They can also be jointly supplied. This means that one product is automatically made when another product is produced. In simple words, one product is a byproduct of the other one. For example, when more beef is produced, more hides will be available to be turned into leather. Wars and disasters. Natural disasters, such as hurricanes, floods and earthquakes, can result in a significant decrease in supply. Discoveries and depletions of commodities. The supply of some commodities, such as coal, gold and oil, is affected by discoveries of new sources. For instance, the discovery of new oil fields will increase the supply of oil. In contrast, if coal mines are expended, the supply of coal will be reduced in the future.